Hello and welcome to this week's BizSmart Lunch and Learn webinar. Our weekly webinars are aimed to provide advice and share knowledge amongst business owners on key business topics and specialist areas. This is part of our service to our Smart Room members. If you are not already a member or a BizSmart client and would like to access our archive of webinars, then please visit our website biz-smart.co.uk and go to the Smart Room page. Our host joining me today is BizSmart Select member Simon Cook from SRC Accountancy Services Ltd. But before we start the webinar, can I ask you all to post any questions that you may have using the question mark function on your screen, and we will do our best to answer them all at the end of the session. Thank you, Simon. Over to you.
Okay, thank you, Caroline. Welcome all. Thank you for joining my webinar today. Just going to go through some things that are going on in the accountancy world that might affect you guys, and hopefully for you cover some ground where we might be able to identify something in your own business where you can save some money, or take some tips away with you. So like Caroline said, if you've got any questions at the end, I'm more than happy to answer them for you. So on we go then. So the first topic that I wanted to cover is the mileage claim. Lots of business owners always ask me the best way to have their vehicle in their company, whether to have a company car, but most of the time I would say in any sort of business, always own the car yourself and charge back 45p a mile to the company or to your own business. This is because HMRC doesn't deem this as any benefit to you at all, because you're charging the company for what you've used. And when worked out, 45 pence a mile is very generous. Now, on top of that, what a lot of people don't think about, or perhaps question with their accountant, is other people that might do some running around for the business. So, for example, if you've got a one-man band limited company, say, and your partner's working, but you could reasonably argue that she pops out, picks up some supplies for you, etc., etc., then when it comes to doing your year-end tax and accounts, we can put a mileage claim in for them. So it's definitely worth considering, even if it's a couple of thousand miles and it's £900 claim that you can put through, it's all worth doing. Just on a quick note on that, it is capped at 10,000 miles, the 45p. So when you go over that, you can actually only claim 25p a mile. And also for VAT registered businesses, you can actually claim VAT back on the mileage claim as well. Okay. So becoming a limited company, there have been some recent changes of with tax on dividends that I think I've covered in my previous webinar. It's still more an advantage to become a limited company, just because still there's no ERS national insurance on dividends. So although they're talking about taxing dividends now, you still don't pay the ERS NI on it, which is a lot cheaper. And also you still get your 5,000 dividend tax-free allowance as well. So becoming limited is still more tax advantageous, along with the actual having limited liability itself, i.e. any of the company's debts aren't on your head personally. And lastly, as you can see on the screen, I've put with no payments on account. So for any of you guys that are self-employed that have had tax bills over £1,000, you'll probably notice that you're paying payments on account towards the next year. If you're a limited company, you just get a one-time bill, you pay it, and no payments up front for the next year. So that's quite good for cash flow as well. Missing key deadlines. So some people do actually still do a paper tax return. So the deadline for doing a personal tax return on paper is the 31st of October, but most accountants and most people now do it online, and you have until the 31st of January. But I always say to my clients, don't wait till January to find out what your tax bill is. You can do it any time from the 6th of April onwards. So most of the people I work with, we try to get them midway through the year prepared for what they've got to pay. Okay. Tax deductible expenses. There's a couple of things that I wanted to point here. Don't forget to claim all your tax deductible expenses. Now what I mean by that is if you're a sole trader or a limited company, there are a lot of expenses that people don't know that they can claim for. Some of the more common ones might be using your home as an office. So if you're doing emails, work from home, you can claim that back. If you're in sort of a trades industry, cleaning your overalls, you know, all sorts of things like that you don't actually need a receipt for, you can just put it through as a claim at the end of the year. The other one that people miss is that if they're out and about and they haven't got their business card with them, or they've got some cash, they forget about all the cash receipts that they've spent for the business. So I'd always encourage people to make sure that they go through their personal bank statements as well as through all their receipts to see if they can find anything that they've paid for that's not going to be on the business bank statements, because people do miss it. And I always ask my clients that question, and you know, most of the time people always manage to find some PayPal or eBay or Amazon purchases they've put through on their own that actually are for the business. So always remember to look through those when you're getting your things together to work your tax out. Annual losses. Another one that you may not be aware of is if you're self-employed, if you've made a loss one year because you've had a particularly bad year, if you paid tax last year, you can actually carry that loss back, and that is actually available to limited companies as well. So if you're a limited company and you pay corporation tax, or if you're an individual business as self-employed and you made a loss, you actually can carry that loss back to the previous year and reclaim some of that tax you paid in the previous year, and the government is still allowing us to do that going forward. Okay. Reducing payments on account. So this is more for the self-employed small business owners. As I explained earlier, if you're self-employed, if you have a tax bill of more than £1,000, HMRC want you to pay on account towards the next year. If, however, you know that you're not going to have a good year as you have just paid your tax bill on, you can actually claim to say, I don't want to pay as much on account because I don't think I'm going to make as much profit as I did in that year. So again, another thing to think about when you get your tax bill, even if you're going online and you do it yourself, there's always the question about if you want to reduce your payments on account. So HMRC are giving you the option to say, look, you know, I haven't made as much as last year, because all HMRC are doing is assuming that you're going to make the same profit one year to the next. Obviously, if you're going to make more in the next year, then I'd just keep it stum and just pay what they want. Right, this is a big topic that's quite new. MTD, for anyone that knows what it means, it's not match of the day to you football fans. That's what I thought it was when I first saw it. It stands for Making Tax Digital. This is a new thing that's come out from HMRC. They want all businesses by 2010 to submit their figures quarterly using the Making Tax Digital service. Now this is a big thing, as you can imagine, because for most businesses they get their books together once a year, either give it to the accountant or tot it up themselves and submit it. HMRC now want your figures quarterly. We fear that this is for them to get their money off you as you go, as opposed to waiting once a year. What I've done for you is to summarise some of the key dates that they intend to implement it. So from 5th of April 18, all small self-employed businesses that are under the VAT threshold will have to start putting in their figures every quarter. What HMRC have initially said is that they're going to make easy usable software available for people to put on their figures themselves. We feel as though this initiative is to stop us accountants, or agents as they call them, doing the figures for you, and encouraging businesses to do it themselves. They identified that basically that us accountants are probably saving you too much money, and they want you to do it yourself, get it wrong, and pay them too much tax. There is a bracket there. They actually have said, and I mean, I don't know any businesses that I work with this, but any business that's under 10k turnover, so for example, if your self-employed business is just a sideline and it does very little, they won't be required to do the making tax digital because they're under the 10,000 threshold. 5th of April 2019, they're going to put it on VAT registered businesses. Again, just putting in quarterly figures to HMRC on how much money they've made. And then from the 1st of April 2010, they're hoping to bring it across limited companies. So again, limited companies will be required to do their well, what used to be annual figures, but submit them quarterly. And I'm sure it's going to be a big change for everybody. So I mean, I'm sure there might be 1 or 2 questions about that after. So, but it's still in its infancy. The revenue is still in their consultation stages, but it will be happening. On a separate subject, transferring assets, just a basic one really. If you've got money in your bank account, remember that you can use up your partner's ISA allowances and things like that. Make sure you're taking advantage of all the lower tax rates. The big one for all you property owners out there is if you're a high rate taxpayer and you have a rental property and you're going to be paying higher rate tax on your rentals, might be a good time to maybe speak to your solicitor and see if you can get the deeds or get the half of the property or maybe all the property transferred into your partner's name, because if they're paying a lower band of tax, then obviously it's better that your partner pays 20 than you paying 40. So that's a big one for the property owners. So something to think about. When can your books be scrapped? Well, they say 5 years after the 31st of January they were due. So once you put your tax return in that was due by Jan, anything 5 years before that you can put on the bonfire or scrap or whatever you want to do. It's quite a common one that people ask. Another thing that's quite useful is if you've got a limited company, even if it's just you in a limited company, get a limited company pension scheme set up, because this can be put through your business to reduce your corporation tax, but put money in you, the owners or shareholders, sort of own sort of pension pot for the future. So it's a nice efficient way of getting money out of your company and putting it into your own pot without paying tax on it. Naturally you will pay tax when you retire on it, but most pensioners will pay it at a lower tax rate than they're currently in at the moment, so it's better to pay less tax in the future basically. I mean, I've covered pretty much everything there on the slides. I do have some other points that, you know, I generally go through with my clients when I sit with them and consult with them and identify areas. So if any of you guys want to ask any more questions or book in and come and see me, you can see the website there is at the bottom, www.srcaccountants.co.uk, or if you want to give the office a call, myself, Ian, Scott or Steve will be there. We'll take the call and, you know, if we can help you, we will. So have we got any questions?
Thank you. Yeah, you've got a couple of questions come through already. The first one is from Louise and she asks, making tax digital, how likely do you think this will happen?
Well, when I first heard about it, I thought this is probably just going to be a rumour. It's ridiculous. I don't think they're actually going to bother implementing this. Then I went on a recent update seminar. The revenue actually there, they did a speech to talk about it. It's definitely happening, definitely happening. There's no way around it. It's definitely going to be coming in. The dates that I've just proposed are the likely dates. They may or may not change, but it's definitely going to be happening.
Okay, thank you. Your next question's from Stuart, and he asks, how long should I hold my VAT records for?
Yeah, so if you're VAT registered, there was one point that I didn't add to the slide. It's actually 6 years for VAT businesses. So if you're registered for VAT, like I say, it's 6 years basically for the VAT, okay, as opposed to the 5.
Thank you. Next question. Paul asks, what happens if I miss the tax deadlines? Okay,
so if you do miss a self-assessment tax deadline, you get a £100 automatic penalty, and after that, the 30 days late, you pay 5% of the tax that you owe on top of the £100, and for people that are more than 3 months late, they've actually brought in a fixed £10 a day penalty. I have had people that have moved to me from other accountants. The other accountants completely forgot to put the return in, and they're nearly a year late, which has cost them, into the thousands of pounds. So it's definitely something that you don't want to miss anyway.
Okay, thank you. Another question from Sean, and he asks, how do you claim back the VAT on mileage?
Good question, Sean. It's something that I get asked a lot. The 45 pence a mile that you claim actually isn't all subject to VAT. So what you have to do when you're doing your VAT is do a separate calculation. So depending on your vehicle, I'm just going to give you a guideline. There are different rates for different vehicles, but generally the 45p is split down into different areas between tax, insurance, repairs and fuel. Now the revenue say you can claim the VAT back on the fuel element. So what we tend to generally use is 12 pence. So 12 pence of that 45p would be fuel. So say for example you were putting in a claim of 1,000 miles, you would do 1,000 miles at 12 pence and then just work the VAT out on that element. So it's not on the whole 45p, it's on what they deem the fuel element, but obviously you can still claim the VAT back. Okay.
Okay. Okay, thank you. I think that's all the questions that have come through for you at the moment, Simon. Thank you again, Simon, for hosting today's webinar. I will be sending out a copy of the presentation and Simon's contact details out to you very shortly. So please do contact Simon direct if you have any further questions. This webinar is part of our service to our Smart Room members, and if you're not already a member or a BizSmart client and would like to access the archive of webinars, then please visit our website biz-smart.co.uk and go to the Smart Room page. We hope you enjoy the rest of your day and that you can join us next time. Thank you for listening.